Welcome back to the deep dive. Today we're diving into the financials of Eli Lilly, a major player in the pharma world. And we've got a specific challenge from our listener. Focus only on the numbers. We're cutting out the CEO chat, the Q&A, just the CFO's opening remarks.
That's right, pure financial deep dive. We're looking solely at the data presented by CFO Lucas Montars from the Q3 2025 earnings call. Slides 7 through 12, basically. Just the numbers, the efficiency metrics, spending, the core financial story.
Exactly, the raw blueprint from the person managing the money. And pulling just from that, one thing really jumps out immediately. Q3 2025 was huge for them. Rapid growth, driven by volume, which led straight to a pretty big hike in their full-year guidance.
Yeah, that really set the stage. So let's unpack that financial foundation, start with those headline performance numbers.
Right. The revenue growth alone is quite striking. A 54% jump compared to the same quarter last year, Q3 2024. That's massive growth in just 12 months.
It really is. And sometimes, when companies grow that fast, you see efficiency slip, costs go up, logistics get strained. But here, efficiency actually improved. Gross margin hit 83.6%. That's up 1.4 percentage points.
Wow, 83.6% gross margin. And the CFO attributed that improvement mainly to a favorable product mix. What exactly does that mean in simple terms?
It's basically means they're selling a lot more of their newer high-profit drugs compared to the older ones. Think high demand, less competition. So the stuff that's flying off the shelves is also the stuff making them the most money per unit. Simple as that, really.
Makes sense. And clearly, they don't see this slowing down because they're immediately plowing that money back into the business. We saw some big investment increases. R&D expenses, for example, jumped to 27%. That's a serious commitment to future products.
Absolutely. And that spending tells a story about their long-term strategy. The CFO specifically mentioned it helped kick off 16 new Phase 3 programs since early 2024. 16.
Yeah,
That's a huge number of late-stage trials. It shows they're really investing heavily to build what comes after their current blockbusters, trying to diversify.
And it wasn't just R&D. On the sales side, marketing, selling, and admin expenses, MS&A, went up 31%. So they're building up the global machinery to launch and support these drugs everywhere.
Right, and you might think, okay, R&D up 27%, MS&A up 31%. How does that affect the bottom line? Are they just spending wildly? But the key metric here is the non-GAAP performance margin. It actually increased by over 8 percentage points compared to last year, hitting 48.3%.
Okay, hold on. Non-GAAP performance margin. Why focus on that specific metric, and what does an 8-point jump really tell us?
Good question. So non-GAAP usually strips out things like one-off acquisition costs, restructuring stuff. It focuses on the core, day-to-day business health. An 8-point jump means for every dollar they make from their main products, they're keeping 8 cents more in profit than they did last year. It proves the massive sales aren't just empty calories, they're translating into real, sustainable, operational profit.
Got it. So the underlying business is becoming much more profitable despite the heavy investment. And the Q3 earnings per share reflected that, hitting $72, although that did include 71 cents of something called acquired IPD charges. What's that about?
Ah, yeah, IPD, in-process research and development. It's basically an accounting charge related to acquisitions. When they buy a company or a drug asset that's still in development, they have to book a non-cash expense. It reflects strategic moves, future bets, not a problem with current operations. So nothing really to worry about there operationally.
Right, okay. And the clearest sign of confidence, the guidance update. They bumped up the midpoint for full-year revenue by over $2 billion.
Let's just pause on that. A $2 billion guidance increase. Well, like you said, that's more than the total annual revenue for a lot of decent-sized pharma companies. It's a huge statement. The new range for 2025 is $63 to $63.5 billion in revenue and non-GAAP EPS between $23 and $23.70. Big numbers.
Okay, so massive revenue, huge spending, strong margins, boosted guidance. But how did they get that revenue? Was it just price hikes, or were they actually selling way more product? The CFO broke this down, price versus volume, right?
Exactly. And this is where it gets a little more complex, especially looking at the U.S. U.S. revenue was up 45%, and that was mostly driven by huge volume growth for Cypanum and Aro, their big incretin drugs. But that volume gain was partly offset by a 15% drop in the price they actually received.
15% price decline in the U.S. That sounds pretty significant, a major headwind.
It does sound like it. But the CFO gave some important context. Part of that steep drop was because of a comparison issue. There was a favorable one-time adjustment for rebates back in Q3 2024, which made last year's price look artificially high. If you strip that out, the price decline was more like high single digits. Still a decline, yes, but the key point is the volume growth was just so enormous, it completely swamped any pricing pressure in the U.S. Volume 1, easily.
Okay, that makes more sense. Now, what about outside the U.S.? Because the international numbers looked even more explosive. Sounds like Monaro is really taking off globally.
Oh, absolutely. Europe revenue grew over 100% in constant currency. Just incredible. Though, full disclosure, there was a one-time boost in Europe, too, a $380 million payment related to some milestone or business development deal.
Right, need to factor that in.
Yeah.
So taking out that $380 million one-off, what was the underlying growth rate in Europe? Still impressive.
Still incredibly strong. Even without that one-time item, constant currency growth was 81%. 81%. That shows really rapid adoption across Europe. And it wasn't just Europe. Rest of world up 51%, Japan 24%, China 22%, all showing really strong volume growth for Monaro.
So the story is clearly volume, 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 especially internationally. Okay, let's pivot to the specific products driving this.
Yep.
The CFO mentioned key products brought in $12 billion this quarter alone. Let me touch on the non-cardiometabolic stuff first. Immunology, oncology.
Sure. So in immunology, their drug EDLS saw U.S. prescriptions jump 41% compared to just the previous quarter, Q2. And the really important bit operationally, over half of new patients are getting it first line now.
First line. Why is getting that first line status so important financially for a drug like EDLS?
Well, first line means doctors prescribe it right after diagnosis instead of trying other things first. So
Yeah.
you capture the patient earlier, potentially for longer. It basically locks in that revenue stream and shows doctors really trust its effectiveness right off the bat. It's a big win commercially.
Makes sense. And oncology.
Verzenio is still the leader in the U.S. for high-risk early breast cancer. International volume grew a solid 14%. And in neuroscience, their newer Alzheimer's treatment, Kissa, prescriptions, grew 50% versus Q2. Plus, it just got marketing approval in the EU.
The EU approval for Kissa, that sounds strategically key, opening up a big new market.
Definitely. The CFO said launches should start later this quarter, rolling out through 2026. It shows they can use the infrastructure built for Monaro in Europe to quickly launch other new drugs. Smart leverage.
Okay, but let's be honest. The main event, the reason for that $2 billion guidance hike, it's all about cardiometabolic health, right? The incretins. Let's really focus on this dual strategy, Monaro and CPAN. Start with Monaro outside the U.S.
Right. Monaro's international story is fascinating. It's launched in 55 countries, all the major markets covered. And here's the kicker, the really surprising detail. Roughly 75% of Monaro revenue outside the U.S. comes from people with obesity paying for it out of pocket.
Wow, 75% out of pocket. So 3/4 of international sales aren't even waiting for government reimbursement. That suggests people want it so badly they're willing to pay themselves. Speaks volumes about the perceived clinical benefit, even if payers haven't caught up yet.
Exactly. It underlines the drug's value proposition directly to the patient. Now, flip to the U.S. CPAN, their newer obesity-focused product. U.S. prescriptions tripled in Q3 compared to last year. Tripled.
That growth rate is just staggering, and the market share reflects that dominance. CPAN ended Q3 with, 71% share of new prescriptions in the branded anti-obesity market. Just huge.
Dominant is the right word. And another interesting detail is the uptake of vials, the multi-dose option. Vials were about 30% of total CPAN prescriptions, but over 45% of new prescriptions in Q3. Shows a shift towards more efficient dosing as the market matures.
Okay, so CPAN's conquering obesity. What about Monaro in the U.S., its original market for type 2 diabetes? Still strong.
Very strong. Total Monaro prescriptions grew over 60%. It actually gained about 4 points of market share just since Q2. The CFO stated it's now the most prescribed incretin for type 2 diabetes patients in the U.S. So holding its own and growing even with CPAN's rise.
So when you put CPAN and Monaro together in the U.S.
Yeah, the combined picture is market domination. The whole U.S. incretin market grew 36% in the quarter, which is healthy itself. But the punchline from the CFO, roughly 2 out of every 3 new prescriptions written in that entire market belongs to a Lilly medicine. 2 out of 3.
Incredible market capture. Okay, let's pull this all together. If we look only through the lens of CFO Lucas Montar's numbers and remarks, what's the core story of Eli Lilly in Q3 2025?
It's a story of just overwhelming success driven by volume, translating directly into really strong financial health. They captured a massive share of the exploding cardiometabolic market, both in the U.S. and internationally. That volume drove huge revenue growth and, crucially, significant margin expansion, over 8 points on that core performance metric. And they're immediately reinvesting that success into even bigger guidance and, importantly, into future R&D. The engine is running incredibly well, fueled by CPAN and Monaro.
Right, that reinvestment part feels key for the future. You mentioned the CFO highlighted the 27% R&D jump and those 16 new phase 3 starts since early 2024. So thinking about that massive financial bet on diversification, what should you, the listener, be watching for? What breakthrough outside of weight loss might be their next big anchor looking at those 16 programs?
That really is the multi-billion-dollar question, isn't it? When a company has this much cash flow and invests it in 16 late-stage trials, they're not just tweaking things. They're actively hunting for the next huge therapeutic categories. Maybe in neuroscience with Kissa leading the way, maybe something new in immunology. Those 16 trials represent their strategic hedge against the inevitable maturation of the incretin market. It's how they plan to turn today's profits into tomorrow's blockbusters. That's where the long-term value creation lies.
Absolutely. Those 16 programs are definitely the ones to watch for anyone looking long term. That was the deep dive. We'll catch you next time.